Thank you very much for being with us this afternoon. Sorry for the communication glitches. As was highlighted, please ask as many questions as you dare, as you wish to, over the next 45, 50 minutes. It's much more interesting to hear questions than listen to me ramble on. Listening to Chris, of course, is a bundle of laughs. So we're going to speak just for a few minutes. Feel free to ask questions as we're doing so. Talking about the exciting region is Latin America, a region known for winning the World Cup, a region that has remarkably outperformed most of the rest of the world for the last few years, despite most people not realizing this. So let's talk a little bit about the trust. It's a trust run by Chris and myself, investing across Latin America and parts of Central America too. There are not too many investment trusts still investing in Latin America. That's what happens when you have a 15-year bear market. People give up. We are not giving up. For us, it is a token of our focus on this part of the world that we continue to travel to Latin America and continue investing in the region. During the last year, Chris and myself have been and experience the glories of Brazil and Mexico and Peru and Colombia and Chile and Argentina and Uruguay and much else besides, because we are very passionate about the region. This trust, as you can see, has a tracking error of 3 to 6%. Obviously, you can read all the other details on there. Typically, we have 30 to 50 stocks. And what this trust does is give you access to the region that is so often misunderstood. So that's enough marketing. Now let's talk about the region. If we go over on to the first substantial page, which is page 4, hopefully people will be able to flip to page 4, he said, hoping. Here we go. So this is the first sort of meaningful slide. One of the really big stories of the last 18 months, but before, is the world splitting into 3. We kind of have the West, the East, for lack of a better term, and then everyone else. And we can kind of show this fairly easily in terms of what's been happening in the United Nations. On air, we just have one of the many votes that's gone on in the United Nations about the war in Ukraine with following Russia's invasion of Ukraine. And this was a UN call for Russia to pay reparations for its illegal invasion of Ukraine. And you can see the blue countries are the ones that voted in favor of the motion, and the red countries, Russia, notably China, Iran, a few others, voting against the motion. But what's most interesting is how many countries just abstained. This was probably not a view on the legitimacy of what Russia did, but it was kind of a view on the necessities of these countries. So countries as diverse as Brazil, India, Saudi Arabia, as you can see, Indonesia, many others abstained and basically said, we need to be on fairly friendly terms with the West. We need to be on fairly friendly terms with the East. And it is our contention that in the world that has split into 3, being invested in the countries that are fairly friendly with the greatest number of countries is an advantage. So what we're seeing today is Chinese firms setting up in Mexico, not because they want to set up in Mexico per se, but because they know that American firms are not going to want to interact that directly with Chinese firms. So instead, the Chinese firms are setting up subsidiaries in Mexico to sell into the United States. What we're seeing is investment from the US going into soft commodities in Latin America or lithium in Latin America, and at exactly the same time, the East, China and others trying to buy those exact assets. So what we're seeing is a dash for the opportunities in Latin America and some other parts of the world by both the West, inverted commas, and the East. And that's kind of a really big story that we see today. If we go on to the next slide, and perhaps I'm going to hand it over to Chris, because so far he has not mentioned anything exciting about Latin America, nor has he mentioned the one thing that we have in common, which is our love for Tottenham Hotspur. Chris, over to you.
Yeah, hi everybody, and thanks for your interest. One of the reasons why we are quite positive on the region of Latin America is that the behavior of central banks in the region has been quite different from the behavior of central banks in the developed markets, including the US and the UK. In Latin America, all of the central banks have raised interest rates quite early fast and by a significant amount, which is why in Brazil, for example, you currently have interest rates as high as 13%, while inflation has already come down to around 4% as a response to the high interest rates. So in developed markets like the US and UK, we are still debating how high interest rates have to go in order to reduce inflation, have an impact on the economy. In Latin America, we've already been through most of the adjustment in terms of the economy slowing down and inflation coming down as well. And so in Brazil, you have a policy rate of 14% or 13% and inflation at 4%. So that gives you a real interest rate of around 9%. Whereas if you live in the UK, you can currently probably get an interest rate of up to 5% on your bank account, but inflation is still running at 7%. So in terms of your real purchasing power, you've probably lost 2% over the past year. Or if you live in London like me, you've probably also seen your rents go up by 15 to 20%, which reduces your purchasing power even more. And so that's why we think that Latin America is an attractive region for capital, because it offers a real positive interest rate for investors and savers. And so that's one of the reasons why we're quite positive on the region.
And in fact, the first questioner asked, what's the effect of UK inflation on Latin American return? And I think the questioner, thank you for the first question, please ask other questions, other people. We will answer them as soon as we see them, is exactly this point, is that in Latin America, the central banks have been sensible and have actually dealt with inflation rather than running away from the challenge of inflation and pretending it will all go away. And I guess the other point is that the central banks in Latin America are used to inflation. If you live in Brazil, you live in Mexico, you are used to dealing with inflation. The average stockkeeper is used to dealing with inflation. The average corporate is used to dealing with inflation, because there's always been a degree of inflation in Latin America. What is different, for example, in the West, is most people aren't used to inflation. If you are under 38, and my honourable colleague to my left is notably under 38, then you've probably not worked in an environment with inflation. Interest rates went to zero in the UK, or close to zero in 2008. So if you started working before 2008, and most people start working, let's say the age of 22 or 23, you are not used to an interest rate. Not just about rising interest rates, you're just not used to an interest rate. And therefore, people's capital allocation decisions probably aren't that good in this environment. Unlike that, if you happen to be working in Latin America, you'll be very much used to dealing with inflation. And therefore, in a world that now has perhaps higher inflation than we've had for 30, 40 years, you have a generation of people that know how to deal with that in, let's say, Latin America, and a generation of people not used to it in the West. Let's go on to the next slide, please. So on the next slide, should we be able to see it, we've got lots of squiggly lines. And these squiggly lines are interesting because they highlight to us two things. One, how cheap Latin America is compared to emerging markets, EM, and compared to the S&P index in the US. And we can see that for much of the last 10, 15 years, the gap between the red line, the S&P, and the green line, Latin America has been getting wider. It's worthwhile remembering, if we go back to the environment when there were interest rates, or positive interest rates, pre-2008, all of those indices had very similar multiples. The US, Latin America, and emerging markets all had similar multiples between about 10 and 15 times earnings. And perhaps that was because people saw growth in Latin America and emerging markets, and perhaps didn't see that much growth in the US. But in the last 15 years, in an environment where there has been pretty much zero interest rates, the gap in terms of PE ratios has pretty much continually widened, with the US getting more and more expensive, emerging markets pretty much staying where they are, and Latin America getting cheaper and cheaper, to the extent where if you look at the bottom collection of lines and squiggly lines, you can see that Latin America has rarely been as cheap as it is today. Emerging markets is fairly decent, and the US has pretty much never been more expensive. And that's really quite interesting when it comes to an environment, when we put that together with what we just saw about inflation, and where inflation is more in line with historical norms or recent historical norms, i.e. Latin America, and where it's not, i.e. the West. So it's kind of strange. In a place where inflation is higher, people are actually paying a higher multiple. That doesn't necessarily make too much sense. And in a place where inflation is kind of in line with historical norms, people are paying a lower multiple. We don't think that makes that much sense. But there we are. That's just part of the attraction of Latin America. Let's go to the next slide with some more red, green, and yellow lines. And back to Chris.
Yes, Sam has already alluded at the beginning that we are facing a period of larger political tensions or geopolitical tensions between US and China, for example, which is driving a lot of companies to nearshore or friendshore their supply chains. So Mexico is a key beneficiary of that, partially driven by the geopolitical aspect, but also partially just driven by economic aspects, such as the fact that the minimum wage in China has actually risen quite considerably over the past 15 years or so. And on a relative basis, the minimum wage in Mexico is very competitive, both relative to Asia and China and relative to the US, of course. And so there are a lot of anecdotes and stories about nearshoring and companies opening up new manufacturing spaces in Mexico. And on this slide, we wanted to demonstrate that these are not only stories and this is not only a narrative, but it's actually also backed up by data. And if you look closely, you can see that the green line, which represents Mexicans' share of US manufacturing goods imports, has now reached a level that is above China. And so Mexican imports to the or exports to the US have essentially overtaken China, and Mexico is becoming the dominant trade partner when it comes to manufactured goods as a result of this. And so overall, Mexico is seeing a positive external shock to the economy, especially the northern part of the economy. And we are exposed to some of these themes by being invested in industrial real estate, for example, which is seeing very, very strong demand. And at the bottom of the slide, you can see the outcome of this, which is that the Mexican equity market, which is the green line, has actually outperformed most other equity markets globally, including the S&P 500 over the past 3 years, which is not necessarily something that we would have anticipated ex ante. So this is playing out as we speak, and we think this will continue for the foreseeable future.
The next question we have, the same question, interestingly enough. Latin America looks like a good buy. Oh, we've done marketing brilliantly today. Why is the discount so wide? I think the discount is so wide for several reasons. It's not because we've done a particularly bad job in terms of performance. Definitely not over the last year, over several years. In certain trusts, one can understand why there's a big discount because perhaps the fund managers haven't done a great job. Perhaps one day we won't do a great job, but definitely in the last year we've done a decent job, probably. I think the reason why discounts on investment trusts in general are quite wide in emerging markets are quite wide is for several reasons. Number one, for the last 15 years, emerging markets have done poorly compared to the US. And so, if you were the average investor over 15 years, not just over the last 3 years, you could buy, the NASDAQ, and it outperforms every single year with less volatility than emerging markets. So I think that, emerging markets in general are out of favor. I think emerging markets have broadly been missold to people many times. People have been sold wonderful blue sky stories of transformational countries and great emergences of the middle class, and lots of wonderful, sweet stories. The reality about emerging markets and Latin America specifically is that everything is kind of dirty grey. Nothing is ever brilliant. Nothing is ever terrible. It's kind of somewhere in between. And selling stuff that's somewhere in between is really difficult because people want to believe wonderful themes and stories and notions of great runways ahead of sunlit uplands. But the reality when it comes to investing is it's hard, it's difficult, it takes time. And the way to make money in emerging markets, the way to make money in Latin America is by being patient, by taking a medium-term view, and often buying the things that people are scared to buy and staying away from that which looks glossy and thematic and beautiful. Because what happens in emerging markets all too often, in Latin America all too often, is that which looks exciting trades at a high multiple, and then along comes a politician or a CEO and does something really, really stupid. And that's the history of emerging markets. So it really pays to be very selective in where one invests and perhaps the most dangerous 4 words are, this time it's different, and believing that anything is perpetual in emerging markets is dangerous. So it's a great question to ask why discounts are so wide. I think it has a lot to do with the sector being out of favor and a sector that's been missold for a very long time. People selling themes, and the word theme just means overpriced. People selling stories, and my belief is the word, story is best left for kids and bedtime. If we go on to the next slide and said, please keep the questions coming. This is some sense of Latin America against our trust against the Latin American index and against emerging markets. And I think it's really quite surprising to many people that despite everyone getting very excited by China and India and wonderful stories further east, the reality is that over the last 3 and 5 years, Latin America has outperformed emerging markets in general, which is heavily Asia-centric. And the reason for that is not very surprising. Perhaps it surprises people to know that, in India, earnings per share has gone nowhere for a decade. Although people get very excited by India, there's a wonderful story and lots of thematics. The reality is earnings per share has gone nowhere for 10 years. And actually in China, it's gone down. So this kind of speaks to the point that perhaps sometimes people, don't necessarily know the data. They hear the stories, they hear the themes, and then they're surprised when some of the markets don't do that well. But I think it surprises people to learn that Latin America has actually done fairly well over the last 3 to 5 years. And despite that, it is still very cheap. If we go over one more slide, this is a slide highlighting the performance of our trust against our index and our share price. And you can see, since we've had some changes in management internally here at BlackRock, the performance is very decent. In terms of positioning and what we like and what we dislike, if we go over one more slide, and we really didn't want to speak for a long time, we really wanted questions rather than our ramble through Latin America. We go through the next slide. You can see our portfolio is sectorally pretty diversified. Weightings in financials, materials, consumer staples, energy, industrials, pretty diversified collection of holdings. The one sector we're not particularly keen on today is utilities. Perhaps we will be one day, but we don't believe that there's very much excitement there. The contrast between utilities and what we're seeing in the consumer discretionary sector, real estate, is quite noticeable. There are really a broad range of opportunities. And when I highlighted earlier the fact that we have been to Colombia and Chile and Peru and Uruguay, that really speaks to the fact there's so much going on in Latin America today. Uruguay, not a country that people talk about, except, I guess, now people talking about the World Cup and the opening game going to be there because in 2030, because that's where the opening game was, or where the World Cup was in 1930. Uruguay is trying to become a regional tech hub. Whoever knew that a country with more sheep than people was going to actually, and is becoming, a place where companies are relocating for the tech expertise and the soft infrastructure that tech corporates need. But who knew that there is a wealth of opportunity for the sort of indirect exposure to EVs because of the lithium production in Argentina and in Chile? Who knew what is going on in Argentina when it comes to Vaca Muerta? Why don't you talk a little bit about Vaca Muerta, which literally means dead cow, but it is not about the wonderful beef exports that Brazil is involved in. Vaca Muerta, Chris.
I traveled to Argentina back in July. And one of the most interesting aspects about Argentina is that they have a massive shale oil and gas field that they're currently developing and exploring at an accelerating pace. The economics of that shale field are quite outstanding. The lifting costs are substantially lower than in the US, for example. And so the economics of companies in that field are truly remarkable. And since the development of that field has only just started, the production growth that most of these companies are expecting over the next few years is very significant. And both the companies that we look at this time, YPF, both expect to double their production over the next few years. And this is also one of the few areas in the economy where most of the politicians agree that it's in the benefit of everybody in the country if the development happens at a rapid pace, because Argentina desperately needs the US dollars, and this is a stable inflow of dollars over the next few years, which can actually change the trade balance of the country to the positive. And so that's why, irrespective of the outcome of the elections that is actually happening in the next 2 weeks, we think that this is quite an attractive area to invest in over the next 3 years or so.
Yeah, as Chris highlights, our elections in Argentina. And the other thing that people forget about Latin America is, despite it being a fractious set of countries, there are a series of democracies. And in democracies, politicians do get thrown out every 4, 5, or 10 years. And so we are likely to see a new president in Argentina come the next few months, just like we saw a new old president in Brazil a year ago. If we just go on one more slide to our last, I think, slide, other than the extremely exciting disclaimers. Just as a reminder, this trust introduced a new policy about 5 years ago. And so we now pay a regular quarterly dividend equal to about 1.25% of NAV at the end of each calendar quarter. We pay that out in May, August, November, and February. So based on the trust share price at the end of December 22, the trust offered a 5.8% dividend yield. Obviously, there are other considerations, and we stress that when people consider investment trusts or any other investment, they should speak to their financial advisor and consider only investing over the medium to long term. So let's deal with some of the question around here. At June 30th, Petrobras, I assume, was company the largest holding. What is your rationale for that? Well, Petrobras being our largest holding.
So the rationale for Petrobras being a large holding in the trust is partially that it's a big part of the benchmark. But Petrobras is also one of the largest oil producers in Latin America. And the large holding was also a positive expression on the direction of the oil price, which has obviously risen quite significantly over this year and especially over the last few weeks. What also needs to be noted about Petrobras is that it's a state-owned company. And when Lula came back into power earlier this year, there was a lot of concern by investors about political interference within the company, which is why the company trades on very, very cheap multiples and pays very, very high dividends.
Let's talk about what those multiples are.
It trades on like 3 times earnings, I think, and pays like 20% dividends.
So that's kind of interesting. There are not too many companies in the world that pay 20% dividend yield and trade on 3 times earnings. So the company has challenges, but within a Latin American context, in fact, within a global context, it's pretty compelling. And so it is part of our investment universe. We won't always be overweight relative or underweight relative to our reference index, but we think, a company yielding 20% in a pretty interesting geological area is quite exciting to us. Next question, in case people think we don't address all questions. Can't get my head around the dividend policy. Seems a bit flaky, asked someone. See, we repeat exactly what the people on this call say. We're not here to attenuate stuff, unless there's swear words in it, and they weren't here. So no, the point here is actually fairly straightforward. Many of the companies in our portfolio actually pay very chunky dividends, Petrobras at the moment and several others as well. And we think it makes sense to pay that back to investors. Now, what's the correct dividend yield at any point? That's a decision for the board. But I think it's worth highlighting that the companies in our part of the world do generate a lot of capital, income, a lot of income, and we can pay that out. Obviously, it varies year by year, but I think it's something that some investors, not all investors, find very attractive. And obviously, the exact dividend yield that we pay is a decision for the board. Why are you so underweight communication services? Because it's a boring sector. Probably would be the straightforward answer. It doesn't mean it will always be boring, but generally returns in the communications services sector. And we go here to page 12. You can see we're 4% underweight communication services. We still have about 2% in the sector. If we go back to page 12, I'm not sure we can go back. You can see it there. Thank you. It's just fairly boring. Like, we love our companies in Latin America. There's nothing really wrong with the telcos in Latin America. They're just not very exciting. And roughly our investments have to add up to 100%. So we can't be overweight everything. And so when we look at the telcos, they're fairly competitive markets, and the stocks aren't really cheap. So if we think what excites us about companies, either it's companies with great potential for growth, or companies that are extremely cheap, or companies with a unique edge, or a company with some distinct product or taking market share. And actually, in the telco world, a lot of the market shares are fairly fixed. They're always subject to changing regulation. And so we may well one day have a lot of exposure to telcos, but they'd have to get would have to get a lot cheaper. I heard you being gung-ho on Mexico. Why are you underweight? Asked one person. Chris, why don't you start that one? And then we'll go with an anecdote today.
So I think it's, first and foremost, we are positive on the region as a whole in terms of Latin America, which is why we are overweight Latin America and our wider emerging market funds. But within Latin America, we obviously have to rank the countries relative to each other. And our underweight in Mexico is partially a reflection that we are more positive on Brazil, which is a little bit further in its economic cycle, and where we think there's more room to reduce interest rates, which will be positive for the economy. And then secondly, it is partially a reflection of the performance that we have shown on the slides a few minutes ago as well, which have just shown that Mexico has been a very strong performer over the past 3 years. And so we have taken profits in a few of our names. And then maybe thirdly, out of the countries within Latin America, Mexico is probably the country that is most sensitive to the US economy. And as we've discussed earlier, the US is a little bit further behind in terms of its economic cycle. Interest rates have been raised significantly this year, but the economy has not really slowed down much yet. And so we think that in 2024, the economy might slow down a little bit more. And within Latin America, Mexico is probably the country that is most exposed to that. So it's partially a reflection that we are more positive on Brazil, partially a reflection that Mexico has performed really strongly, and partially a reflection that Mexico is more sensitive to the US economy.
Yeah, and I think it is worthwhile remembering there are elections coming up in Mexico as well. And there's always a risk with elections. And I think the other thing is that it's become just a little too consensual, too many people loving the country on a global basis. And in fact, in the last 24 hours, we've had a bit of a surprise to many people in Mexico, where the listed airports suddenly saw a change, or potential change in regulation. And these are companies that have had the same sort of regulatory backdrop for the last, almost since 1998 for some of them. And suddenly there was a change or potential change in regulatory backdrop, and the stocks fell at the time of we came into this meeting sort of up to 30, in one case 40% today. And that's a big move for what's often a fairly quiet and, as it's perceived, boring part of the market. My point being that areas which people believe are safe sometimes can be very risky, because people think there are no risks. And in emerging markets in Latin America, there are always risks. While we like the overall outlook for Mexico, as Chris said, we can't be overweight everything. And we're just a little concerned when everyone else is excited by anything. We'd rather be hunting in the areas where people are a bit more scared. And next question. What is the smallest company you will invest in, and the maximum amount? Your comment on Uruguay prompted this question. Let me just start off with Uruguay. There's a very small market in Uruguay, but there are companies based in Uruguay that are listed elsewhere, and that's probably the type of investment we'd be making in Uruguay. So there are companies that have headquarters in Montevideo, but because the market is fairly small there, they'll be listed in the US. We have no problem investing in companies listed in the US or indeed the UK if it were to be relevant, just because they're, but doing all their business in Latin America and not listed in Latin America because, their country is too small. In terms of what's the smallest company you will invest in, typically most of our stocks are, north of $500 million. That's not always the case, but it's not always the case, but that's generally what we'd be thinking about. And we don't want to be dominating the shareholder base of any company. We want to be able to exit when we see something we don't like and vote with our feet. So this is not about, and it's important to highlight this, when we're investing, this is not about changing the company or trying to get countries to change their models of governance. We're not trained lawyers. So we always want to have a small enough position in a company, so if something is going on that we don't like, we can leave. This is not Hotel California, where you can check out anytime and you can't get out. We know that some investors like to build up very big positions and try and get companies to change. We kind of feel that in lots of Latin America, that is a fool's errand. So we never like to dominate the shareholder list of any company, and happy to invest in companies typically from $500 million upwards. Obviously, it depends on their free float. Mark, perhaps you're home by now. You haven't asked any questions. Obviously, other people can also ask questions, but you've been surprisingly silent.
Hi, yes, I'm home now, but I'm having trouble because Zoom won't let me have two instances. So I'm still on the phone, but at home. I have a couple of questions. Currency. I mean, you're obviously dealing with some interesting currency fluctuations in the geography that you're dealing with. What's your approach to currency risk and currency risk management?
Yeah, I love the word "interesting" in that context. It's like I've got an interesting next door neighbor who insists in playing music at 2 a.m. Yeah, that's the word "interesting" in that context. Chris, would you like to deal with interesting currency approach?
Yes, I mean, maybe we can go back to slide 5 actually. And so when we think about the currencies in Latin America, I think there's probably two major things that we look at. And one of the things is the real interest rate that we have in the country.
Slide 5, please. Yeah.
And
one more.
So one of the things that we look at is the interest rates that are offered within the country, and you can see that countries like Brazil and Mexico, and also the others in Latin America, actually, they offer some of the highest real interest rates in the world. And this means that it's an attractive destination for foreign capital. And so high real interest rates attract foreign capital, which is obviously positive for the currency. And so these are financial flows that we look at when we think about currencies. The other thing that we look at are the flows of the real economy, which is the trade balance. And on that metric, most of the countries in Latin America also look quite positive at the moment. So we've seen fairly high commodity prices over the past year. We are currently still see high iron ore prices despite a fairly weak Chinese economy. So iron ore prices are at 120. Oil prices just rose to around $90. Soybean prices have been pretty decent this year. And so Brazil is actually running the strongest trade balance that it has in 15 or 20 years, I think. And so from external flow of money inside and outside the countries, Brazil looks quite strong. Mexico also looks fairly defensive and neutral as it's growing its exports to the US. And so we always, when we invest in these countries, you always take a deliberate view on the currencies, and it's a key part of our macro views.
Yeah, I'd just like to add that, perhaps unlike in the UK, typically in Latin America and more broadly across emerging markets, when a currency goes down 10%, the market goes down 20%, and you lose 30% pretty much overnight. And that's kind of been the history of Latin America and beyond. And so it's really important for us, as Chris was saying, when we assess a country, we think about the macroeconomics, the politics, fixed income and the currency before we get to equity. Equity is a very small number between two large numbers known as assets and liabilities. And therefore you get wiped out when there's a really big mess. And so the bottom line is countries where we're very concerned about the currency, we really don't want to be there. That's kind of the general rule. So
Thank you.
That helped answer your question.
Thank you. And I can't see Q&A on my telephone. I can see
No,
something
we don't
on.
optically have any other questions at the moment. I mean, I could ask lots
Okay.
of questions.
No, I was going to ask one more. The chat is, hi Mark, are you there? That's okay. Well, I'm going to ask one more, which, if I may, which is why an investment trust?
Yeah, it's great.
And I suppose is the strategy available, or a similar strategy available anywhere else in BlackRock in a different wrapper? So
yeah, so the first thing to say is there are not many investment trusts doing Latin America. A round number of one, if that were a round number, looking at Latin America today, which again speaks to the fact that people have kind of given up, which is why we're so excited by it. We do run an open-ended fund investing in Latin America. I think the difference is, in this case, we don't actually run any institutional money in Latin America. So we're completely focused on our open-ended fund and this investment trust. We're not distracted by anything else. I think the attractions of an investment trust are several-fold. Number one, our ability to gear. And if we're positive on the region, it kind of makes sense that we can do that. Two, our ability to pay dividends and to do so in a sustainable way. It may not be everyone's cup of tea, but it's definitely some people's cup of tea. The fact that we have an independent board supervising what we do, I think, is really important in a world increasingly focused on corporate governance. I think that's kind of interesting. And although it may not always appear so, given the vagaries of reporting standards, sometimes investing in an investment trust actually works out, not always, sometimes an investment trust works out as cheaper than an open-ended fund when all costs are borne in mind, rather than just the ones that appear on various KIDs in different ways. Obviously, please speak to your financial advisor. So we love the investment trust business. We think this is a great way for the average man in the street to invest in Latin America. And I think it's a part of the world that possibly doesn't get the attention it should deserve, and neither do the investment trusts. And of course, given the fact that we trade at a big discount today, you can get these assets at a cheaper price than you could in an open-ended fund.
yes, I'm a believer. The issue from a manager perspective is scaling an investment trust, and particularly when you're sitting at this level.
We would love to be in a position where we could issue shares. Obviously, one can only really do that when one's trading at par or above. And it's something we have done in another investment trust we manage, in our Frontier investment trust. We were able, for a long period of time, to issue shares. We can't at the moment. So we do believe with good performance, our discount will close, and people will get excited by this region once again. And we'd love to be in a position where we could issue shares. Obviously, technically, we probably can't at the current level, which is a reflection of the discount.
Thank you. And the strategies that you run, open-ended and investment trust, are they identical, or are they?
They're not identical. No, we don't. But we don't believe in treating different clients the same. I.e., people who invested in investment trust are going to, as I said, typically have a degree of leverage. Typically have perhaps a few smaller cap stocks, a few mid-cap stocks, because we can have a slightly longer horizon in an investment trust than we can have in an open-ended fund. That's probably the other major difference, which I didn't touch on earlier, which is important to highlight, the fact that we can just be a little longer term in an investment trust. And I think if one actually looks at the performance of the investment trust against the open-ended fund, even though it's been managed by much the same team over time, the investment trust has meaningfully beaten the open-ended fund over long periods of time. And that really speaks to the duration of investors, and the fact that duration of the capital of investors, and the fact that people aren't running out exactly at the wrong time, when there's suddenly a scandal hits the newspapers and everyone says, oh, I need to sell, or vice versa.
Yeah, no, I agree that permanent capital is a lot more flexible from a manager perspective, and allows you the comfort of expressing your views without it being chipped away at with redemptions all the time. I think I saw, and I can't find it now, a reasonably large cash holding. Am I mistaken?
You are mistaken. I mean, sometimes, okay. Yeah, you are mistaken. And we don't have. There may be some cash backing the CFD, but I'm not. No, we have no meaningful cash exposure. Net cash exposure. No, we are slightly geared.
Understood. I must have seen a different presentation today and got confused. That's certainly it from me. I would very welcome for anybody else to have. Otherwise, I'm
Yeah,
going
any
to
other questions? For example, we'll answer any questions. You know, are Spurs going to win the Premier League? Absolutely. I'll ask myself other rhetorical questions. Is Chris Brinkman a better footballer than me? Absolutely. You know, there are lots of other questions we could ask or address. So if anyone has any other questions, please give them to us now.
Fantastic. Or feed them through us afterwards, because I'm sure they'd be happy to receive them separately. That's a fantastically upbeat presentation. Much enjoyed. Very informative indeed.
Our risk in Latin America, invest for the medium to long term. I'm sure by the next time we do one of these, there will have been a scandal somewhere. Something will have gone wrong. That's one has to remember. Invest for the medium to long term. We will do another one of these with you, Mark, in the next 6-12 months, and you will ask the question, how come you didn't forecast X, Y, Z happening? And
yep.
That's true.
Yep.
We've just been asked, is there an Indian trust that we run? No, we don't run a dedicated Indian trust, and I would personally be cautious about India today. A great country, great long-term future. However, when one starts seeing adverts in the public domain for buy now, pay later on shares in the newspapers, and lots of adverts on public transport encouraging people to buy mutual funds, I think one has to be a little cautious on the Indian market. Great long-term story, but probably a little too expensive for me, at least in the short term. So we don't actually run a dedicated Indian trust. So thank you for that question. Oh, how many of your holdings are ADRs? How many on the stock exchange? Thank you, sir, for your question. You see, as I try to close, we get more questions. Questions that we get asked. To us, it doesn't really make too much of a difference. Sometimes ADRs can be trading at a slight discount. Sometimes there are no local markets, as I said, no meaningful markets like in Uruguay. The vast majority of our stuff trades locally, but we do occasionally have some ADRs. But broadly to us, it's not a big focus, the difference between the two. Any other questions? Last chance. Okay.
I think you squeezed quite a lot of questions out of this audience. Well done. Sam, Christoph, thank you very much indeed. That was very interesting, and hopefully you'll see some secondary activity in your investment trust as a result of it.
And please reach out to us if you have any other questions, and thanks for having us.